Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I hope you had a restful weekend and enjoy a productive week ahead. First up, today, Chinese financial media outlet Caixin published a special cover story report on the housing crisis, and the domestic outlet doesn't mince words, writing, quote, "Despite China's government throwing just about everything in its policy basket at the real estate crisis, the sector continues to deteriorate, with sluggish sales, a growing list of unfinished projects, and mounting debt repayments. Consequently, more developers than ever are on the edge of defaulting on their maturing bonds, estimated to be worth over 2 trillion yuan, $357 billion US. End quote. Today's video will be very housing sector heavy. Being such a critical part of the national economy, it's important that we continue to follow these developments closely. And for part 1, we will examine salient points made in this Caixin cover story. Recent revelations indicate that the housing crisis, which is stretching into its 3rd year, quote, has now spread to state-owned developers whose deep pockets had largely insulated them from the chaos, as well as some of the largest private developers. End quote. These developers had until recently been viewed by investors as among the few capable of weathering the industry-wide debt crisis. More than one institutional investor told Caixin that a default by Country Garden, for example, could have repercussions across the nation similar to China Evergrande Group and, quote, completely tank whatever confidence the market has left in the sector, end quote. Others agree. Quote, it's not just an industry issue now. Other external economic factors have had a strong negative impact on home demand and consumer confidence. If you want people to buy homes on mortgage, they must establish a relatively strong expectation on future employment and income. End quote. We remember in June, new property sales by China's 100 biggest real estate developers fell 28.1% year-on-year, and that was already against a low base. Among the 100 biggest developers, less than 30%, most of them state-owned, reported year-on-year growth in property sales in June. 27 companies, mostly private developers, reported declines of more than 50%. And early data indicate that in July, the decline has accelerated, with almost all developers' monthly sales reaching record lows. One sales executive at a state-owned developer, speaking to Caixin, said that the company's sales in July were so far about 40% of the level that they saw in April, and visits to new projects have collapsed by over 70%. And the stakes for local governments facing their own fiscal crisis are especially acute. Quote, if the real estate sector risk is not properly resolved, local governments whose fiscal revenues rely on land sales to developers could face a sharp decline in revenue and increasing default risks of local government financing vehicles. End quote. But of course, this is much bigger than local fiscal conditions. The real estate industry, together with its related sectors, account for anywhere from 20 to 30% of the economy. And the sector, 3 years in, still remains very sick. Now, we will return to the housing sector shortly, but first we need to discuss the flooding concerns across the country too. Over the weekend, Beijing's National Meteorological Center posted a red alert as it forecast heavy rains in multiple provinces, mostly in the country's north, the first time the highest alert has been published in nearly 12 years. The body posted on social media that, quote, the flood control situation is grim, end quote. With this alert, the Ministry of Emergency Management raised its own emergency response to the 2nd level of their 4-tier system for 6 provincial regions, including the capital city of Beijing. Popular tourist spots in the capital announced temporary closures over the weekend. Construction work involving waterways were suspended, and shipping on these waterways also had to suspend operations. The warnings come as Typhoon Doksuri crossed the country over the weekend, and more weather events are expected like this in the coming weeks. Local state-run Beijing News warned on Saturday that coming rainfalls could result in, quote, extreme amounts that could possibly break historical records, end quote. The last time a red alert was issued was in July 2012, when Beijing saw its heaviest rains in 6 decades, resulting in 79 people dead. Okay, next up, we return to the housing sector. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit that like button. It's also a massive help if you can share this episode with people who are interested in China developments. This is the best and currently the only main way in which the channel can grow. And for anyone who can go the extra mile and help keep China Update financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Okay, now returning to the housing crisis, we will move through several important developments related to the sector. Chinese financial media outlet Yicai Global reports that China's banks have reacted coldly to the People's Bank of China's proposal to cut existing mortgage rates. The proposal can help apartment buyers to cut their financing costs and to some extent reduce the risk of them breaching their borrowing agreements by repaying their mortgages early. It may also help increase consumption across the country. However, Yicai writes that banks, already under their own pressures and exposed to a high proportion of personal mortgages, are not happy with this proposal, which would result in them losing out on income it earns on the interest. The central bank remains concerned, however. At a recent press conference, the director of the Monetary Policy Department of the People's Bank of China expressed that due to changes in the price relationship between wealth management yields and mortgage interest rates, residents are using deposits or reducing their investments to repay existing loans in advance. Interest dynamics are having flow-on effects across the system too. Quote, most home loans were issued when the market was hot, and as a result their interest rates are quite high. As interest rates continue to fall, it is inevitable that the lending rates on existing mortgages will also be trimmed. End quote. Over the weekend, the People's Bank of China published new numbers showing that China's housing market continued to contract as the total amount of money lent out to buy residential property shrank from a year earlier. This is the first time this has happened on record. The outstanding amount of individual mortgages fell to 38.6 trillion yuan, $5.4 trillion US dollars, as at the end of June, down 260 billion yuan year on year. That's the first year-on-year drop in the data since records were published going back to 2011. Meanwhile, late last week, the Minister of Housing and Urban Rural Development urged financial regulators and lenders to strengthen efforts to revive the nation's property sector, including by treating home buyers who have paid off previous mortgages to be considered as first-time purchasers and relaxing down payment rules and reducing mortgage rates for first home purchasers. Currently, buyers of a second home are subject to more restrictive borrowing limits put in place to reduce the risk of systemic financial crisis. These restrictions have actually been removed in most cities across the country, but remain in place in 10 major cities, which historically have seen super hot markets and sky-high housing costs. And finally, for today's episode, some updates on a few big players. Over the weekend, China's property giant Shimao Group Holdings Limited posted a combined loss of 48.6 billion yuan, $8.6 billion US dollars, for the financial years 2021 and 2022. The numbers were published to meet a deadline to stay on the Hong Kong Stock Exchange. Shimao's shares had been halted since last April after it failed to publish unaudited annual results. Earlier this month, a $1.8 billion US dollar project by Shimao failed to find a buyer at a forced auction, quote, underscoring its difficulties liquidating assets amid a weakening property market, end quote, in the words of US-based Bloomberg. The same day, last Friday, China Evergrande's Hong Kong-traded car-making unit, China Evergrande New Energy Vehicle Group Limited, which at one time it had hoped to be a lifeline for the embattled developer, proved to be nothing of the sort, plunging more than 61% on the Hong Kong Stock Exchange as trading resumed after 16 months of suspension. The price did see some rebound in trading on Monday, today. According to a long-delayed earnings report published 2 days before, the car-making unit suffered combined losses of about 84 billion yuan, $11.7 billion US dollars, for the past 2 years. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a great Monday, have a productive week, and I will see you all tomorrow.